90% of traders open a chart and they see random lines moving up and down. But professional traders don't see randomness, they see structure. And once you understand this structure, the market starts to make a lot more sense. In this video, I'm going to explain market structure in the simplest way possible. By the end of this video, you should understand what market structure is, how to identify trends, what are trend continuations and trend reversals, and how do they apply to our trading, and one of the most important concepts that traders use, which is the breakup structure. And later in this video, I'll also explain why certain price levels in the market become extremely important for traders. So let's start from the beginning. What is market structure? Market structure is simply the pattern price forms on a chart. Now, when you open a chart, price is constantly moving, up, down, up again, down again, and these movements create a pattern of highs and lows. That pattern is what we call market structure. I'll do a little illustration. Up, down, up again, down again, up again, down again, and so on. These highs and these lows are what come together to form the market structure. So everything you see together like this is the structure of the market. Think of market structure like the skeleton of the market. Just like your body has bones that hold everything together, the market has structure that organizes how price moves. Now, without market structure, trading charts will just look like random noise, and trading will be almost impossible. Market structure tells you what stance or position the market is taking at the moment. Like, is the market sitting or standing or doing a push-up? The answer to this question, when you ask it, is what the market structure is at that point in time. Now, if you look closely at any chart, you will always see points where price pushes up and points where price pulls back. These turning points are what build the structure of the market, just like I have explained with this illustration. Now, once we understand structure, the next thing we'll try to determine is something very important. But before that, I would like to show you the market structure on an actual chart. Now, this is what a market structure looks like. As you can see, we have a high here, we have another high, we have another high, we have a low, we have another low here, there's another low here. All these things together just form the market structure basically. This, like, when you're able to identify the structure of the market, you've literally solved 50% of your trading questions at that point in time. So now, after understanding market structure, what do we try to understand next? What we try to understand next is what we call the trend. Now, what are trends? A trend is simply the general direction the market is moving in. Markets move because buyers and sellers are, constantly competing. Buyers push price up, sellers push price down, and from this battle, the market forms trends. And there are two main types of trend actually. We have the uptrend and the downtrend. But let's look at the uptrend first. Now, an uptrend happens when price is generally moving upwards. On the chart, this usually looks like higher highs and higher lows, meaning price keeps pushing higher over time. And when the market is in an uptrend, traders usually look for buying opportunities because the overall direction of the market is upwards. So it is only reasonable that you are looking to buy. You shouldn't be looking to sell when you're in an uptrend. Now I'll explain with a visual representation. So this is a perfect example of an uptrend. You can see that price formed a high here, but then price formed a higher high, and price also formed a higher high at this point. So simply put, an uptrend is a series of higher highs and higher lows. So let me illustrate this before we come back to the chart so you don't get too confused. Okay, so you can see this high here. This is a high. This is another high. So this is a high. This is another high. This is another high. This is another high. So why do we call this a higher high? We call it a higher high because it is a high that was formed in the uptrend that was higher than the previous high that was formed. So that's why it's literally called a higher high. Yeah, I know it sounds funny, but that's just the concept of the market. You understand? It's called a higher high because it's a high point in the market that is higher than the previous high that was formed. So you have this point as a higher high, and then you have this other point as a higher high, and then you have this other point as a higher high. So when you see a series of higher highs like this, it actually tells you that the market is going in a particular direction, which is to the upside, making it an uptrend. And then you also have higher lows. So this is a low, but you can see that these lows here are higher than this low here. So this becomes a higher low. We call this a higher low. This point too is a higher low because it's a low point in the market that was formed at a higher price than the former low. So it is called a higher low. Now when you see a series of higher highs and higher lows, then you should know that that is an uptrend, and you should only be looking for buying opportunities in an uptrend. Now if I take you back to the chart, I'm sure it will make a lot more sense now. You have this high, now you have this high, now you have this high. So this was a higher high than this high, and this was a higher high than this high. Now this was a low, this was a higher low than this one, this is a higher low than this is a higher low than this. And just like that, that's how you are able to identify a trend that is moving in the upward direction, thus making it an uptrend. Now, we move to the second type of trend, the downtrend. And what's a downtrend? A downtrend happens when the market is generally moving downwards. So it is the opposite, the complete opposite of an uptrend. And this usually looks like lower highs and lower lows, meaning price keeps pushing lower over time. Now, when the market is in a downtrend, traders usually look for selling opportunities because the overall direction of the market is downwards. So like I said, it is the complete opposite of a downtrend. So therefore, you should understand that we are looking to do the complete opposite of what we will do in an uptrend situation. So we're only looking to sell. And I'll explain with an illustration again as to what I mean by lower highs and lower lows. So just like for the uptrend, we had higher highs and higher lows. For a downtrend, one of the ways to identify a downtrend is that you see a series of lower highs and lower lows, and I'll explain. Now, this is a high. This is a high. This is a high. But what can you notice? I'll give you some time. Okay, so For those of you who got it right, you would notice that there is a series of lower highs. So for instance, this is a high, but then there is this high which is a lower high, and it is a lower high because it is a high point in the market that formed at a lower price than the last high. So it is a lower high. Once again, it sounds funny, but that is the concept of the market. And this is another lower high. So when you see a series of lower highs like this, it is an indication that the market is clearly moving in a downward direction. And these are lower lows. This is a lower low. 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 Why? Because it is a low point in the market, or it was a low point in the market that was formed. But then price came down and formed another low that was lower than the former price. I hope that makes sense. So we have this low. This low is a lower low because this was the previous lowest point in the market, but price broke below it and gave us a low here, and this became a lower low than this one because you can see that clearly. Probably this was a price at $2, and this would probably be a price at maybe $1. I don't know, I'm just giving an example. So that makes you understand that this low was formed at a lower price than the previous low. So it is a lower low, and it goes on like that. This is also a lower low because it formed at a lower point than the last low, and so on and so forth. This is also a lower low. So when you see a series of lower highs and lower lows, lower highs being these ones and lower lows being these ones, then you know that the price is pushing to the downward direction, and that is a clear indication of a downtrend. Now I think I will have to take us back to the chart again. Okay, so this is a point I was able to identify in the market. This was a clear downtrend. Now you can see this was a high. This was a low, rather, not a high, a low, and this is a lower high. This is a lower high. This is a lower high. Anywhere where you see these rectangles, there are points in the market that you should take note of. That's why I put the rectangles there. So lower high, lower high, lower high, because you can see that price clearly reacted at those points. So this was a clear downtrend, and you also have the lower low. This was a lower low. This little point here was a lower low, although I didn't mark it out. This was a lower low. This point here, this was also a lower low. And this was also a lower low. So you can see that when you have a series of lower highs, these points, and lower lows, these points, it is a clear indication that price is moving downwards, and therefore we can call that a downtrend. So having said that, you might want to ask, but is the market always trending? The answer to that is no. The market does not always trend, and sometimes price just moves sideways. You understand? And that is where we have the choppy market. Now, what is a choppy market? This is when price keeps moving sideways without really trending in a particular direction. This is also called a rangy market. So price just goes up a little, down a little, but it's not really going anywhere. It's not having a clear trend. It's not having a clear direction. Now, when you see price moving sideways like this, it is usually a symptom or a sign that you are in a choppy market or a ranging market. And traders are usually advised to stay away from such markets, especially when you trade with the trend, because um, a choppy market would not trend in a particular direction, so you can't really make money there. So traders are usually advised to just stay away from a choppy market. Although there are few occasions where some traders have come to say that they make money from choppy markets better, but that's a very few percentage of traders. The majority of traders actually stay with the trend and they trade with the trend. That's how we make money. So in these situations, it actually becomes difficult to determine the true direction of the trend because there is no clear trend. So this is why, like I said, many traders prefer to wait for clearer market conditions, and they usually wait for one of two things to happen. But before I talk about that, I'd like to give a visual representation. So first of all, let me make an illustration of what it will look like. Okay. Okay. So this is what a ranging market will look like. A ranging market will just not really go in a particular direction. It will just keep going up and down, going sideways, and not really making any series of higher highs or lower highs or all of those things that have to do with the trend. So this is what a choppy market would actually look like. So I think I should also show you guys what this will look like on the chart. Okay, yeah, I think I marked out this point. So this is what a ranging market would look like. I mean, you can see this is clearly not going, it was clearly not going in any particular direction for quite some time. It was just going up again, down again, and just like that. So in a market condition like this, a trend trader is usually advised to stay away because you can barely make money from this kind of market. So with that being said, I'll tell you one of the two things that traders wait to happen when we are in a choppy market or a market where we actually cannot take any trade. We have to just sit and wait and see how our own setup is going to play out. I will explain what a setup is sometime later in another video. So one of the things to wait for is a trend continuation. So a trend continuation happens when the market pauses briefly and then continues moving in the same direction. Yeah, so just think of it as inhaling before exhaling. The pullback before the momentum. When you are swinging a catapult and you put your stone or your pebble and you pull back. Exactly. So a trend continuation is actually a pullback before a move, before a continuation of the trend move. So for example, imagine the market is moving upward. Okay, let's do an illustration with this. Now, imagine the market is moving upward, price pushes up strongly, but after some time, it pulls back a little before going up again, and so on. This temporary pullback that happened here is called a retracement. This thing that happened here, where price moved from this point and came all the way down here, it is called a retracement. A retracement simply means price moves against the main trend temporarily. But now if buyers are still strong, price will eventually go back up and break the previous high, which is this. So according to this illustration, we can say that buyers were strong because buyers came back up and broke above this high here, broke above it before another retracement started to happen. You understand? So when price breaks that previous high and closes above it, it usually signals that the trend is going to continue. So when price broke above this high and closed above it somewhere around here, that signaled to us that the trend was going to continue in this illustration, for instance. And it shows us that buyers are still in control and they are willing to set a new higher price as far as that trend is concerned. So it means that we are expecting buyers to, at some point, break this high again and set a new high, because like we said, higher highs and higher lows, that is how we know that a trend is in an uptrend, and lower highs and lower lows for a downtrend. So we're usually looking for, price to continue in the direction of the trend and make a new high or a new low for us to know that the trend is going to continue. Now, with that being said, let's move on to trend reversals. Now, what's a trend reversal? A trend reversal happens when the direction of the market changes completely in the opposite way. So, for example, the market has been in a downtrend, for instance, and price keeps making lower highs and lower lows. But then something changes and price suddenly pushes upward and breaks an important level in the market, which is this point right now. It brings an important level in the market. At that point, the structure of the market has begun to shift and the trend may actually be reversing. In trading, there's a popular saying, the trend is your friend, which simply means traders usually prefer to trade with the direction of the market and not against it. That's why experienced traders, they wait for a clear confirmation before assuming that a trend has reversed. So in this case, you can see that price broke above this point, which was the last point in the market where the sellers came in strong and pushed the market to the downside. That was the last lower high that was formed in the downtrend. But then price started going up and buyers came in strong, and price has been able to break this level and close above it. Immediately price closes above this level, we can say that the trend has reversed, and we can now be waiting for a retest, a pullback to any of the zones that will be above this zone, anywhere around here, and price will continue to the upside and we'll confirm our trend. Sorry about that. That was too okay, yeah. So price moves up and it just basically continues to the upside overall, and we know that that's already a trend reversal. So that's it. Trend reversal is kind of like the opposite of a trend continuation. It indicates to us that the bias has changed, and in this case, according to this illustration, buyers have come in and they have taken the sellers out. So let's look at that on an actual chart. Okay. All right, so we are going to look at two different scenarios. So this is an uptrend. I mean, this is it is clearly an uptrend. You can see this was the point where we explained with before, and it is an uptrend like we've already determined. So how did we know that the market was continuing the trend? You can see this high here. Like I said, for a trend to continue, the previous high has to be broken, or the previous low has to be broken. So in this case, this point, price broke above it and closed above it here. This indicated to us that this trend was continuing, and then price dropped and started going up again, and at some point price broke above this level again and closed above it, which indicated to us that the trend was continuing again. You understand? So that's how you indicate the continuation of a trend. Every other thing that happened inside here before price got to this level, it wasn't really a clear indication of a continuation yet, until price has to break above this high for you to say, okay, the trend is actually continuing. You understand? So that's how you identify a trend continuation. And then a trend reversal, on the other hand, I mean, you can see this point here. I marked it out, and the reason why I marked it out is simple. Price actually did break above this high here. I didn't mark this high, but this was a high in the uptrend, and price broke above it, and then it retraced and came down and then went up. Price broke above this high again. Now this made this point our point of interest. This made this point the lowest point in the market, where if price should break below, we would know that the trend has reversed. And guess what? Price came down all the way here, broke below it at some point. So for a short period of time, no, it doesn't actually for a short period of time. For quite some time, this was a downtrend. You understand? Because price had broken below this level. So everything that was happening here was actually a downtrend. Actually, realistically speaking. But then at this level, price came back up and it was able to take out this high, and this was the highest point in the market. Now it might begin to seem a little bit complicated, but you can just go back to the illustration that I made, and with the illustration you'll be able to actually understand what I'm talking about in the chart right now. You understand? Because having to illustrate it with some freehand drawing is definitely not going to be the same as actually applying it on real life chart. So that was how the trend got reversed again and became an uptrend. And we had price pull back all the way down here before going up, and it eventually broke this high again, continuing the trend. Now after that, what happened? This point became the lowest point in the market, because all the way from this high, price dropped, came here before it started moving up to the upside. You understand? I'm giving you the very, very, very realistic way to understand market structure. This is how best to understand market structure. Now price went all the way from here until the momentum was strong enough to break through this high. Where did that momentum start from? It started from this point. So this point became our lowest point in the market that was of interest to us, where we were looking at price to probably break. And if price could break through this low, we would know that the trend is not continuing to the upside. Breaking this low means that a reversal has occurred, of which price has now done. So we are now looking to sell, and the trend has reversed. I hope you get that. Now, like I said, if you don't understand, just go back to the illustrations, look at the drawings, study them, and bring that knowledge back again to the real life charts, and you might actually understand better what I'm saying. Now for this downtrend, price actually moved up, came down, moved up briefly again at this point, and continued down. So this was a continuation of trend because this was the lowest point in the market. You understand? But price broke below it, went up a little, and started coming down. So it means that the trend continued. And then there is this low that was here. Price moved up a bit from there, and then it came back and broke below it, broke below this low. So again, the trend continued, came down all the way here, went up again, tested these highs, started coming down. Eventually it broke through again, which indicated the continuation of the trend again, and then until we got to this low. Now from this low, you can see that something interesting now happened, which was price just kept going up. Price just went fucking ballistic and just kept going up and upward. In this point, price broke above it, and when price broke above it, it actually became an uptrend. And that was how we were able to know that, okay, this is now a reverse trend. Like the trend has been reversed from a downtrend to an uptrend. Now that's it for trend reversals and trend continuations. So there is a particular concept that traders use, or one of the confirmations traders look for is the break of structure. The break of structure happens when price breaks an important level in the market structure. It means price breaks a level that previously controlled market movements. Now, example. Imagine price is moving upward. Price pushes up, then drops. That level where the drop started, which is at this point, it becomes an important level. Why? Because that level showed where sellers were strong enough to, pull the price down. Now, if price later returns to that level and breaks above it, then, like we said, something important has happened. The structure has been broken to the upside, and that will signal a trend continuation. Now, in the reverse case, where it continues to the downside and eventually breaks the structure where the major move to the upside started or continued, because this could have also been a continuation, you understand? That would now be a trend reversal because price has broken below it and closed below it. So it will be that the trend has changed, and we'll be waiting for a retest and then a continuation to the downside. Now, if price instead drops lower and breaks a key level where buyers previously pushed the market up, like this level, then the structure has been broken to the downside, and like I said, that signals a trend reversal. So I already explained this with the structure and all of this. So you can just go back a little in the video and you would understand what I'm talking about. So this is basically break of structure. This point where price broke above this high and closed above it, break of structure. This point, break of structure. This is break of structure. This point here with this red candle coming down here, break of structure. Yeah, this point with this red candle coming down here too, break of structure. This point here, price breaking below it, break of structure, testing it, coming down. This point to price closing below it, break of structure. I mean, break of structure is literally what we look out for when it comes to trend reversals and trend continuations. Break of structure is that thing you are looking for, actually. So with that being said, I'm going to explain something that you might have noticed. You might have noticed something, which is that there are certain price levels in the market that keep becoming very important turning points. You understand? And these are areas where price reversed or price reacted or price broke structure. And these areas are extremely important in trading because they represent the places where buyers and sellers are actively competing for control of the market. And traders often refer to these levels as support and resistance. But there's a deeper way traders look at them called those zones of interest. You understand? They are our zones of interest. And understanding these zones can completely change how you look at charts. So let's quickly recap everything that we've talked about. We said market structure is the pattern price forms on a chart, and from that structure we are able to identify the trend, and that trend could either be an uptrend, which is a move to the upward side generally, or a downtrend, a move to the downward side generally, or sometimes it could be a choppy market, just moving sideways, not really going in any direction. Now, within those trends, the markets will either continue the trend, which is a trend continuation, or it will reverse into a new one. And one of the key signals traders use to identify all of these things is the break of structure. And once you begin to understand this concept, the market stops looking random and starts to make a lot more sense. Trust me on that. Now, if this video helped you understand market structure better, please make sure to like the video and subscribe to the channel, because in the next video, I'm going to break down something that every trader needs to understand, which is the zones of interest. Now, they sound like an important part of the market structure, right? Yeah, that's because they are. These are the areas in the market where the biggest reactions usually happen, the supports and resistance. And knowing how to identify them can completely change how you analyze charts. So if you don't want to miss that, make sure you are subscribed, and I'll see you in the next video.